Let's turn to business news now with Matt Chatterton. Matt, I think you're doing a tremendous. Matt used to be a sports reporter, went off in his big OE and came back reinvented as a business reporter. You're taking to it like a duck to water, Matty. Retirement village operator Somerset Group is forecasting an underlying first half year profit despite a drop in sales. Explain that, young Matt.
Yeah, I'll try to explain that in plain English for you, John. It's forecasting an underlying profit of between $43 and $45 million for the first half of 2018. That's around a quarter of a quarter on what they had at the same period last year. Just some background on Somerset. It has about 5,000 residents and 23 retirement villages in New Zealand. They've got 7 more in development. Overall sales volumes were 299 for the first half of the year for these units at the retirement villages. That's actually down from 323, which I guess probably isn't considered too good for New Zealand's third largest retirement company. To break it down, new sales for units for the first half of the year were 145. That's compared to 179 for the same time last year, while resales were actually up slightly to 154 compared to 144. There are a couple of reasons as to why the new sales were down for the company. A number of sales staff actually left in the first half of the year, and Auckland's tight building market meant that some units took longer to complete. I did speak to the CEO, Julian Cook, today. He said the drop in sales was nothing to worry about and that he believes the company is still on track to hit all its targets for the year, including those 7 developments around the country, and I will note that 2 of those are in Auckland.
Thanks, Matt. Electronic card numbers for June showing that we are buying more this winter year on year, is that right?
Yeah, well, I don't know about you, but down here in Wellington, it's actually been quite cold, so I've actually needed to be rugging up with, the old scarf and the beanie.
Yeah.
I'm borrowing. Patrick O'Mara's here, so Patrick, I will be putting this back on your desk. Don't you worry about that.
But having said that, that's the use of a prop, Matt.
Yes,
I mean, this is just taking RNZ into the 21st century.
Oh, I'm always trying to expand and create new opportunities, so to speak, John. So consumer retail spending rose about 0.8% for June on May. The strongest gains were in consumables such as groceries and apparel, as I have here. However, I did speak to an economist today who said that the momentum was expected to slow for the rest of the year. That's due to a bit of a cooling in the housing market, so households are trying to save a bit more money and not planning on going out and spending. So that is expected to stay going down, I guess, for the rest of the year. And funnily enough, that was actually the pattern for the last 3 months. The trend has been going down over the last 3 months.
Right, thanks, Matty. What happened on the markets today?
Yeah, good point. Well, the NZX has closed down again today. It's sitting at 9,022. That's a 39-point drop. The US is trading at 68.4 cents. There's no real change there today. The Oz is up slightly. It's sitting at 91.6 cents. And the pound has weakened against the New Zealand dollar. Oh, that's just minutely though. It's up a bit to 51.7 pence. So not much of a change.
Thanks very much, Matt Chatterton, doing business for us out of Wellington this week.